most Canadians running their lives on autopilot are trapped in their careers. They're stuck retiring when the world tells them to retire, probably at the age of 65. But I got a feeling you're different. You won't settle for that. You want to retire early. And it is possible, but it turns out retiring faster isn't about making one massive financial move or hitting the lottery. It is, though, about avoiding a few common mistakes and then making a pile of small, intentional decisions that completely transform your retirement timeline. So meet Casey and Stacy. They're in their early 50s. They're living in the Toronto suburbs. They've got a solid income, a nearly paid off home, and just over $1 million in retirement savings. On paper, they're doing pretty great, but here's the catch. They've lost track of their spending, and their current plan has them working till age 65. Now, when they came in to see us, they were feeling pretty good about their financial situation, but they did feel a little guilty about not knowing exactly where they stood. And after some digging, we actually discovered a series of tweaks that shaved 5 full years off of their retirement timeline and allow them to retire at age 60 without sacrificing the life that they want. So in this video, I'll walk through their story step by step. I'll show you exactly how they did it and how you can too. Hey there, I'm Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, ideally pay less tax along the way. Now let me reintroduce you to Casey and Stacy. They're a couple in their early 50s who could be just about anyone you know. Maybe even they look and feel a lot like you. Casey works full-time in a corporate role as an executive. He's earning about $160,000 a year. He's been with a few different companies over the years. He's climbed the corporate ladder, kind of building his career. Stacy works part-time. She's bringing in $25,000 annual, and she absolutely loves the flexibility that it gives her to focus on things outside of work. Volunteering, hobbies, spending time with their kids, all who are now kind of grown and moving on out of the house. Now they live in a home that's worth $1.35 million in a Toronto suburb. It's the same house that they raised their family in, and it's starting to feel a little bit big now that the kids have moved out and it's just the two of them. But it's comfortable and it's familiar. They only have about $30,000 left on the mortgage, and that should be gone in about 2 years. Now, on the surface, Casey and Stacy, they feel pretty good about where they're at financially. They've got over $1 million in retirement savings. $800,000 is sitting in Casey's old RRSP, and $300,000 is in Stacy's spousal RSP. They don't carry any credit card debt, and they've been pretty diligent about paying off their mortgages, why they got that small balance left on it. Now, beneath the surface, things are going to feel a little fuzzy. A few years ago, when their kids moved out, Casey and Stacy stopped keeping close tabs on their spending. They didn't really mean to. It was just kind of something that happened. Life got busy, probably. They didn't have to worry about tuition costs, kind of all the extracurricular stuff, other kid-related expenses. They kind of just figured they were doing fine. And now they don't know exactly how much they spend every month. Stacy feels admittedly a little guilty about that. She used to be the person kind of on top of their budget. Casey kind of just brushed his off, saying, we're not doing anything dumb with our money. And he's not wrong, right? They're not racking up, bad debt or blowing their paychecks on luxury items or anything like that. But still, there's kind of this nagging feeling in their mind. They're wondering, are we saving enough to retire when we want to? Could we be doing more to make our money work harder? Or are we going to have to work till age 65 or maybe beyond? When is this going to be done? And here's the kicker. They're just not sure where to start, right? They've done some research, but between the jargon and the conflicting advice, it just all feels overwhelming. They wanted clarity. They wanted a plan that they could trust. Most importantly, they wanted confidence that they could retire sooner rather than later. Now, what we discovered together completely changed their trajectory, and it can change yours too. Now to start, let's just run a quick benchmark analysis to see where they're at today. Now, problem number one is that they don't know their spending. So we have to do a bit of a quick and dirty estimate. So on $185,000 of combined gross income, they'll be paying about $55,000 of taxes, CPP, and EI contributions, which is going to leave them about $130,000 of net dollars to allocate to the mortgage and these lifestyle expenses. So for this benchmark test, this base case, we just assumed a lifestyle expense of roughly that, and then we continued that through the rest of their lives. We put a 5% rate of return on their savings, best guess on CPP and OAS, and then we modeled it out. And it turns out their concerns that they had, they were legitimate. Even though they're still 15 years away from retirement, an age 65 retirement at that, the benchmark tests actually show them running out of liquid savings at the age of 85. This is not good. And if that's not looking good, just imagine how it'll look if we actually execute that retire early plan and try to pull all of this off at the age of 60. Yeesh! Liquid assets at this point are now gone at age 74, a time at which they need to realistically still have 20 years left of life ahead of them. So that's the problem that we need to solve. They need to get clarity here. So the first thing that we had to do was we had to rediscover what their actual real life spending is going to look like. Now, while Casey and Stacy, they kind of felt good about their spending, they admitted that they had lost awareness of where those dollars were actually going. And awareness is the key here, right? Because without clarity, it's just going to be impossible for anyone to optimize this plan. So they went back, they pulled their records for the last few months of their spending, they kind of chucked it all through a tool to identify some trends and some behaviors to see if there's any opportunities to redirect money towards that early retirement goal. And it turns out they were spending about $1,500 a month on what they termed as absolute non-essentials, completely kind of not memorable things, impulse buys, subscriptions, dining out, all this miscellaneous stuff that when push comes to shove, they were happy to part ways with. Of that $1,500, they decided to purposefully redirect then $1,000 per month to a separate savings pot to start building up some cash reserves. This left them with about $9,000 of net after-tax spending every single month on what we were going to model. The next thing we had to target was their actual targeted retirement savings program. Now, Casey recently switched jobs, and when he did, he gave up his formal group retirement savings program. That savings program had a really nice matching component to it, but that's now gone in his new job. Now his gross pay is higher, but that retirement savings, it's all on him. So we worked back to identify how much savings he would need in order to actually hit that $9,000 per month lifestyle amount that they figured they would need. We'll automate that savings so that what's left in their bank account is 100% spendable. So we'll hop into the planning software here and double check that that's all been entered. We'll automate that savings, right? And so by now we've dialed in their spending to a realistic number, and we've automated 2 streams of savings. This extra savings from their kind of discretionary spending and their core retirement savings. The question is that enough? We step back here to the high level net worth projection, and it turns out it's not. They're still out of liquid funds by the age of 84. So we got to keep on working at this. Now next, let's look at their home. Now they're living in a $1.35 million home. I said it was in the suburbs of Toronto. The home worked really great when they raised their kids, and they still absolutely enjoy it, but they're starting to imagine a future where a smaller place might work just fine. Their kids all couldn't afford living in the city, and so they've taken jobs further out of town, and so they figure that realistically, they'll be able to downsize to something, say, 10 or 15% cheaper to free up some home equity. The timing, though, would be quite important. We didn't want to do this right at the same time as retirement. That's going to be too much change for them. But a year later seemed appropriate. So when we inflation adjust this, they'll be selling their $1.35 million place for about $1.66 million, and then they'll be buying for about $1.4 million. And that's going to free up $250,000 just after they retired. So that's going to certainly help. We're getting there. Again, if we fly high and take a look at that net worth projection, it looks like we're making progress. We're still not quite there yet, but we're making progress. Now, next, we're going to spend some time looking through those old group retirement accounts. How were they actually invested? Were they invested? We hadn't taken a look at this yet. Now, again, Casey and Stacy had been living on autopilot after he changed jobs and the kids moved out. So they really haven't had much time or frankly interest to take a look at this stuff. And while the asset mix, right, the mix of stocks and bonds, it looked appropriate, the costs of those exposures was not. It was actually wildly inappropriate. And so we showed them how they could recreate a more efficient portfolio that could maybe maintain a similar kind of like overall mix, but come in at a 75 basis point or a 0.75% cost savings to them. Now, this cost savings is going to go completely into their genes. And because this is going to be modeled out over 25 years, this is going to have a huge impact. Now, how huge, you might ask? Now, this single change will increase their pre-tax estate by about $1.8 million by the time they're 95 years old. It's absolutely huge. It is a massive lever, and one that they really hadn't considered looking at in the past, purely because they didn't know what else was out there or if what they were doing was actually that bad. It turns out it was. So by this point now, they've got a plan that works. We zoom out again, let's take a look at that net worth projection, and it looks entirely different than that original benchmark case. But we got to soldier on. We tackled their spending today, but what about their retirement spending? What was the right number for them to spend in retirement? Now that we're at this point, is it possible to, how do I put this, increase their spending? Is that even possible? So we tried it. So we kept it at $9,000 a month all the way up to retirement. And then we increased it to $10,000 per month for the first 10 years of their retirement. So $120,000 of net after-tax spending money, kind of free and clear. And then because the evidence shows most retirees' actual spending in retirement follows a retirement spending smile pattern, something that we often talk about here on this channel, we reduced the spend back down to $9,000 net per month from age 70 to 85, and then down to $8,000 a month from age 85 to 95. Of course, all of these numbers are going to be indexed. So when we look at the cash outflows here in real terms, it just looks like this, right? 10 more years at that $9,000, then getting permission to actually spend more in retirement for 10 years, and then the spending is going to slowly regulate down to kind of a more sustainable amount in the later years. So last time, let's just quickly zoom out again, take a look at the net effect of all of this. And this actually also now works too. Incorporating this realistic spending pattern into the plan shows both a pay raise in the early years of retirement, but also a reasonable amount of flexibility in the later stages. Now let's keep in mind, they still have their downsized home at this point, right? That's their fail-safe, their safeguard. But even without it, this still looks awesome. We still haven't done any tax optimizing of their retirement cash flows here, right? There's no strategic risk meltdown or any of that, no testing of the timing for CPP. There's still a ton of things that we'd want to review together with them. But for the purposes of this video, of this case study, let's just stop here and take stock of where we've come from. So option one was a failed late retirement at the age of 65. That had them outliving their liquid assets to the tune of about $1.4 million. Just a little bit of an overshoot. Now, after reviewing the budget, we resolved that sloppy spending. We restarted and automated their savings for a 10-year sprint. We booked a projected downsize at age 61. We fixed their lousy and expensive investment kind of product. And then we incorporated a retirement spending smile with a pay bump in the first 10 years of their retirement. That brought us all the way here to the end, where we're left with a scenario that's better by nearly $2 million, and it has them retiring 5 years earlier than planned, even if they don't make it that long. And the second of them passes away by the time they're 87 years old, not 95. This improved plan still has them ahead by over $1 million on a pre-tax basis and $459,000 on a net estate after tax basis. It's like absolutely awesome. That is how you retire faster than 99% of Canadians. Let me tell you, I can't think of a more fun job than helping people like Casey and Stacy get meaningful answers to these types of questions. Like seriously, our whole team over here wakes up every day giggling that we get to do this. Now, if you aren't dialed in on your numbers, and if you've got enough moving parts that make things just a little bit more complex than you're comfortable with, we'd be happy to help. Every month we set aside some time to help folks here in the YouTube community. And if you'd like to grab one of those times, I'll put a link in the description below and you can make that happen. Otherwise, hey, that's all for now. Thanks as always for watching. I'll see you in the next video.